Hey guys, Main here from Breakout. This is another episode of our trading course. This video is going to focus on trade execution and trade management. So the difference between a good trader and a really great trader can sometimes come down to how they manage and execute their trades. A major part of being a successful trader is having very good trade execution and trade management skills. In this video, I'm going to give you some tips and tricks, and we're going to go into some strategies to hopefully help you level up your game. First up, we're going to talk about order types. So the two types of orders we're going to focus on are market orders and limit orders. A market order is exactly what it sounds like. It's entering the order at the market. This can be great in a volatile, fast-moving market. It's also great if you're trying to get in or out of a position fully quickly. It does have its drawbacks though, primarily slippage. Slippage is going to be the difference between your expected fill price and the actual fill that you receive. This is a major thing that you need to pay attention to, especially in crypto, because it's such a volatile market. Slippage can happen for a few reasons. The volatility of the market itself, by the time you execute the order, price is already moved. So you might hit a market order at $100,000 Bitcoin. By the time you've pressed the order, price has already moved up $100, and that's where you're going to get filled. Liquidity is another thing you have to consider. If you're trading Bitcoin or Ethereum or Solana, liquidity might not be as much of an issue, and you can get your position filled close to or right at the price that you want to execute at with a market order. However, if you're trading a more liquid asset, perhaps an altcoin, the liquidity at the price you see on the screen might not be enough to fill your position. So the actual fill you get might be worse based on the available liquidity in the market. Position sizing goes into this as well. If you're entering a small position versus a large position, you might experience less or more slippage based on the asset you're trading and the liquidity available to you. A limit order is an order that is put into the market at a specific price that you desire to be filled at. So if you want to precisely choose where you enter or exit, you can use a limit order. If you want to get filled at $100,000 Bitcoin exactly, you can put a limit order at exactly $100,000. Limit orders can be great if you want to have very precise entries and exits, but similarly to market orders, you do have to understand that liquidity at the market, the volume traded at any given price, might mean you don't get fully filled on your position. So if you have a sell order at $100,000 Bitcoin, price trades to $100,000, but it only trades there for 1 Bitcoin in volume, and you had a 5 Bitcoin sell position, you might be left with a partial fill. So let's get into the breakout terminal, and I'll actually show you what this looks like in practice. So now we're at the terminal here. You can see the chart, you can see the market depth, the new order window. So the market depth is going to show you the available liquidity at a given price point on both the buy and the sell side. You'll see order books and market depth on centralized exchanges. Again, trading Bitcoin, the liquidity is going to be very good. So if I go ahead and enter a 1 Bitcoin long here at market, very good chance I'm going to get filled immediately at the exact price that I saw because the liquidity was available to fill me there. It was a market order, so I filled instantly, and it was only a 1 Bitcoin long, which is about a $98,000 position size. So the liquidity was available to fill me at that exact price. Now, if I was using a larger position, let's say I want a long 4 Bitcoin. I see 98,304. I go ahead and enter, and it still filled me at 98,304 because the liquidity was available at that price in the market immediately. So where you might run into problems with slippage are going to be on maybe less liquid coins that are more volatile, moving more quickly, where your position size isn't going to be executed exactly at the price that you see. So if we look at Chill Guy here, and I hit send order 29.64, and you can see I actually got filled at a slightly worse price. I got filled at 29.66. That is slippage. So based on the position size that I was entering, because I entered at market, it wasn't able to fill my entire position at the price that I saw. The difference between the expected fill and the actual fill, that is slippage. It is a market order though, so regardless, it filled me immediately. It finds the liquidity where it's available and it's going to fill you. Same thing here. I can go ahead and exit, and I'm now out of that position. Now, a limit order, I'm going to determine where I actually want to enter or exit specifically. So if I open up this order entry window again and I change this to limit, you can see I'm now choosing the price. So I want to enter at exactly 0.29. So I'm going to go ahead and hit send, and you'll actually see that the order doesn't pop up on the positions tab here because it's not filled. The order went in, but the order hasn't been filled because it's set below price. And as you can see here, the order is actually showing on the chart here. So if price comes down and tags this line where my order is, I will get filled, and I'll get filled at exactly the price that I want to. This works the same on your sells. You can choose exactly where you want to sell at instead of closing out with a market order. However, one thing you have to consider is partial fills, like I discussed earlier. If price comes down here and not enough volume is traded to fill my entire position, just because I had the order there, it doesn't guarantee that my entire position will get filled. So when you're deciding whether to use a limit order or a market order, you got to think about all these things. What are the assets that you're trading? Is it liquid? Is it a liquid? Are you entering with extremely large size into a major coin, or are you entering with large size into a less liquid coin? Where and how you want to enter? Are you going to be watching on screen and you can execute that live? Are you going to use a limit order because you're not going to be on screen and you want that order to sit there and potentially get filled? Maybe you're away from your desk, maybe it's overnight. These are just a few things that you got to think about. Next up, we're going to talk about low time frame entry techniques. So this is going to build upon a little bit of the last video where I taught you guys some price action trading concepts. Low time frame entry techniques involve using multiple time frames to actually execute your trade idea. This is going to allow you to get a more precise entry, a precise exit, and it's going to help improve the risk reward potential of your setups and just overall improve the types of trades that you're taking by using multiple time frames as confluence. So we're back on Bitcoin here, and we have this 4-hour order block. If you remember from the last video, it's the down candle before an up move that broke market structure. You can use this to take the trade on its own. You could enter on the order block right now. You could put your stop below the order block. If you want to take your trading to another level, one thing you're going to want to practice doing is using the low time frame to better refine your entries so you can get even better risk reward. And by using a high time frame in confluence with a low time frame entry technique, you're going to actually improve the risk reward and hit rate of your setups. So looking here at the H4, we've got our bullish order block. So I want to be looking for longs. My bias is long, the trend is up, I'm into an area of support. So instead of just entering on the H4 chart, I can actually go down and look at a lower time frame here, like the 15-minute. And what you can see here is we actually have another order block within the H4 order block. So this is our H4 order block. And within that H4 order block, we have a 15-minute bullish order block, down candle for the up move that broke market structure. And we've now come back and retested it. So instead of just entering on the H4, where we actually have to have a quite wide stop, we can now go down to the M15 and get an entry here with a stop below the M15 order block. Now price doesn't have to trade nearly as high or nearly as far for us to get a satisfactory risk to reward. If we were to target the highs, this is a 7R trade. Now, if we were just to enter on the H4 on its own, we'd be entering at the start of the H4 order block here, and we'd have our stop all the way down here. So to the same target, but using the H4 on its own, it's only 1.25 for the risk to reward. Not nearly as good. So when you use the lower time frames, you're going to be able to, again, refine your setup and get higher risk reward plays, and even potentially allow you to increase the confidence in your setup because you have multiple time frames aligning with each other. Again, we talked about this in the last video. The H4 is bullish, and so if I go down to the M15 and I find another bullish setup within that H4 area like we've done here, that's a higher confidence trade, and our invalidation is much tighter, giving us a way better reward to risk. And this works on all different time frames. You can use the H4 and the M15. You could use the daily and the hourly chart. There's not really any sort of rules. The idea here is you use the higher time frame to form your bias and to look for reasons to be bullish or bearish. You mark out your support and resistance levels, your order blocks, your breakers, and things of that nature. And then you can go down to the lower time frame to further refine that setup and actually dial in a very precise entry and exit. So let's go over one more example here. So here we have Ethereum on the hourly. We have an order block. And again, we could enter this trade at the order block with our stop below, target a new high, and the risk reward is pretty good. It's 3.5R. That being said, we can zoom in further, being bullish on the hourly. Again, the trend is up. We're in an hourly order block. We can zoom into a lower time frame, and using our same concepts, we can find a confluent setup that's going to give us potentially a better risk reward. So within the hourly order block, we're now on the 5-minute chart, and you can see here I have a 5-minute order block, and we can potentially look for price to now retrace here into the 5-minute order block, which is confluent with the hourly order block, and give us a much tighter low time frame entry while still having that high time frame confluence. So you could go ahead and set a limit order here because price is not at this level right now. And again, if we target a new high here, you can see the potential risk reward of this setup is much higher, well over 6. So these are just a couple examples of low time frame entry techniques and how you can use the high time frame as well as the low time frame together to really dial in your setups. Now we're going to talk about monitoring your trades on an appropriate time frame. What I mean by this is if you're in a trade based on the daily chart, there's no reason to be monitoring that trade on the 5-minute chart. It just doesn't make sense. The trade is based on the daily. You do not need to be looking at the 5-minute chart and micromanaging. The time frame in which you execute is the time frame that you should be monitoring your trade on. Nothing lower than that. If you're executing a 4-hour and a 15-minute trade, you don't really need to go below the 15-minute chart at all. And really your focus should be on the 15-minute and above. If you're executing a trade based on the hourly chart, you have no business being on the 1-minute chart. If you're executing a trade on the weekly chart, you have no business being on the 4-hour chart. Now, I'm not saying that you can't look at other time frames to see if things might be changing, but the analysis that you're doing on the high time frames, that's what you need to trust, and that's going to help you to not babysit and potentially mess up a really great trade because of some low time frame noise that is not relevant to the time frame in which you're trading. There's no set in stone rules for how to do this, but I'll give you some examples that I use personally in how I execute trades. So the primary time frames that I'm executing, if I'm executing on the weekly and the daily, I don't go below the daily to make decisions on that trade. My high time frame is the weekly for my bias, my support and resistance, my order blocks, etc. And then I'm executing that trade on the daily. So if there's a break in market structure on the 1-hour chart, that's not affecting the trade because I'm watching on the daily. That's where that decision is being made. If I'm taking a trade based on the daily and the hourly chart, again, the daily is my high time frame. I'm using that for my bias and my technical levels, and I'm finding my execution and my actual entry on the hourly chart. I'm not going below there. I'm not going to be watching on the 5-minute chart for reasons to exit my trade. I'm going to be watching on the hourly. If the H4 is my high time frame, I'm usually executing on the 15-minute chart. Again, I'm not going to be going below the 15-minute and looking at the 1-minute to find a reason to get out of that trade. And lastly, if I'm taking a scalp, usually the hourly chart is my high time frame and the 5-minute chart is my execution time frame. And at that point, you're pretty much as low of a time frame as you can get other than the minute chart. But again, you want to avoid babysitting. If you're doing a trade based on these specific time frames, trust your analysis on those time frames. Don't fud yourself out of a position or out of a good setup because of low time frame noise. So let me give you some examples of what this might look like. If I'm entering an Ethereum long based on the daily chart. So I'm entering a retest of this daily level here, okay? And I might go down to the hourly to actually execute this trade. And let's say I use this breaker as my entry. So here's your breaker. It's the up candle for down move. It gets reclaimed, remember? So that is my entry there. So I'm within the daily order block and I have an hourly breaker that I'm using for my entry. I don't need to go below the hourly. Imagine if none of this price action existed yet, of course, and we didn't know what was happening. So if I go down to the 15-minute, let's say, which is lower than my execution time frame, I might get caught up in some of this noise. I might have entered the trade here on the retest of the breaker, and then I'm looking at the 15-minute chart, and I'm like, oh no, hold on, we just broke market structure. That's a big, scary red candle. I might decide I'm gonna puke this position because the 15-minute chart looks really ugly, only to find out that I should have trusted the daily and the hourly, which is what my trade was based on. And you can see the result, price rocketed upward after that. So you're gonna mess up a lot of your trades by over managing them, going on too low of a time frame, getting yourself mixed up and losing sight of the high time frame analysis that you've already done. So this is a really good example of that. Looking at the 15-minute, this kind of looks a little bit sketchy. Obviously here we know what happened, so it doesn't quite have the same effect, but it looks a little sketchy here. You might see this and say, okay, well, maybe this is actually going to trade lower based on this big red candle. I'm going to get out of my long. But if you actually zoom back out to the hourly, which is where you took this trade, none of that happened. The hourly was simply a retest of the breaker. You're still well within your area of demand. Your stop loss, which is down here, hasn't been breached. There's nothing to worry about. So very often traders will overanalyze and babysit their trades. Sometimes that will cause you to make mistakes, and sometimes it's just a waste of time. It's not an optimal use of your time. Let's look at another example here. On the hourly chart, we're retesting this order block. You might say, okay, great. This is an awesome time for a long on Ethereum, and I'm retesting this hourly order block. My stop goes down there. No need to go below the hourly. However, if I'm on the 1 minute chart, you might look at this and say, well, you know what? The 1 minute's looking quite bearish. It's lower highs and lower lows constantly. It's breaking. Oh, we have support here. It broke. More support. It broke. And you might actually exit this trade because you think the 1 minute chart looks kind of bad and it's in a downtrend now, and now you're going to be wrong. When you're forgetting that this trade is based on the hourly, and on the hourly, all we're doing is retesting the order block. So any low time frame price action in there is really just noise relative to your setup. Your stop is still down here. The hourly chart looks completely fine. So you want to be careful about where and how you're monitoring your trades to make sure that you're trusting your analysis, you're not over analyzing, babying that trade, opening up the room for mistakes, and really just wasting time in general. Next, we're going to talk about evolving risk to reward ratios. So earlier in the course, we talked about your standard risk reward, your RR ratio. You want to aim for an asymmetric risk to reward. So for every dollar you risk, you can potentially make $2 or $3. This ratio, however, can evolve as the trade progresses and plays out. Let's say a trade is going in your favor and you decide to move up your stop loss, maybe to break even, maybe just up a little bit to a new recent swing low. You've now evolved and changed the reward to risk ratio of that trade because the amount of risk you had on initially is no longer the amount of risk that is still open on the trade if you were to get stopped out. This can also go with moving your profit objective higher. Let's say you're aiming for a 2-to-1, price is approaching your target and things seem really bullish and you want to raise that target. That RR ratio has now again evolved because the potential reward is even more. But we're going to focus on just the basics of how your reward to risk ratio, your RR ratio, can evolve throughout the trade. Let's assume we took a long off of this breaker, right? The up candle for the down move that took out a swing low, and you get a nice little retest there. So initially your trade was from this level to this level. So your stop is at this low and your target is at this high. The initial reward to risk for this trade, let's just move this a little lower just for easy math. So let's assume you're taking this trade on Ethereum here. So you're entering off of this breaker, the up candle before down move that took out liquidity, and you're entering on the retest and you have your stop at the swing low here. The initial risk to reward ratio for this trade, right, is 4, right? So for every dollar you're risking, you potentially are going to make 4. That is the RR ratio to begin the trade. Now, how could this potentially evolve as the trade progresses? So let's say that price is moving up like it did here. And now that we formed a new swing low, which ended up being your entry, you want to move your stop up, which is going to take some risk off the trade. So let's just say initially you were going to have your stop here, and now you're going to move your stop up to this low here. All of a sudden, the reward to risk ratio on this trade has changed drastically because no longer do you have the full $1 at risk that you had here. This is almost a break-even stop, not quite, but now let's say this stop out would only be 10 cents because you've brought your stop up. So if price would come back all the way down here and stop you out, you would not take the same loss that you would have taken when you initially set up the position. The R ratio has changed. This goes the other way as well. So if we were to get to your target here and you say, well, you know what, it's a bull run, I think things are going to go even higher, and you move your target up to 5R, let's say, the RR ratio has changed here because the amount of money that you stood to make initially was $4 for every $1 risk. Now, if price comes up here, you're actually going to make $5. The risk reward, again, has changed. This can happen in a few other ways throughout throughout the trade as well. I mentioned compounding positions, but can also happen if you de-risk some of your positions. So let's say you get to here about 2R and you decide to now take part of the position off. So you close half the trade here, you lock in $2. And then price continues to trade higher to your original target, which was initially 4R. Again, the initial 4 risk reward trade that you took is not the same because you now only have 50% of your position on here. So when price reaches that full take profit, you've actually only made $1 on that remaining 50%. So you made $3 and your risk was still $1 here. So that is now changed from your trade being a 4R position to a 3R position. Again, it's evolving. So there's a lot of different ways that this can happen. This is just a few of them that I'm highlighting here. So moving your stop, increasing your potential take profit, closing part of your position, compounding the trade. So we'll quickly cover that. I don't want to go into too detail because I don't think you should be compounding your trades till you really get confident in what you're doing. But let's say you're in this trade here and you see this little pullback into this little order block here and you say, I want to add more risk. So now you're going to add to your position size here, increasing the overall position, which also increases the overall risk on the trade, again, evolving that RR ratio. So maybe you had $1 risk here, and now you have a new position that you've entered right here with your stop there and the same target. And on this trade, you're also risking $1 with another potential $4 return. So now you have 2 trades running, right? 2 positions running, each with their own $1 risk and their $4 reward, but you now have twice as much risk out on the market. Whereas if you were to come down here, let's say this didn't go up like this and it came down and stopped you out. Now you're out $1, came out and stopped you out of here. Now you're out $2. So that initial $1 that you're risking is no longer accurate. You had $2 at risk on the market. Yes, the reward was higher, but you've changed things by compounding that position. Now, everything I've discussed here goes for the other way as well. So if a trade goes against you, you enter a trade, you risk $1 here to make 2, and then it comes down here and you say, you know what, I don't like it, so I'm going to close it early, and you exit your position here and you only took a 50-cent loss. Again, that's a different risk reward than you initially had because you've managed the trade, you've closed some of it early. Maybe you decide to only close 50% of the trade here. So you've closed 50% of the trade. This now becomes 50 cents at stop out, right? But you've also taken a small loss here. You've taken a 50-cent loss, and then price actually ends up going to your target. You're going to have a different risk reward because you took a loss of 50 cents and you only had half of your position on. So now all of a sudden, instead of being a 2-to-1, that ends up being a 1-to-1 trade. So it's evolved. So there's a bunch of different ways. I've just highlighted kind of the major ones here in which trade management can actually change the risk reward of the trade once it's in play. So to summarize, the risk reward that you initially set out within a trade can evolve as the trade progresses. There's a handful of ways that this can happen: moving your stop loss, moving your take profit, compounding the position, taking partial profits or partial losses on the position are just a few of the ways that I've covered in this video of how that risk reward ratio can evolve throughout a trade. Now we're going to talk about probably the most common trade management thing that you see on Twitter, and especially with new traders. It's the dreaded stops to break even. So you're going to see a lot of people often talk about moving their stop loss to break even once a trade is progressing in their direction. So what does this mean? It means simply taking your stop loss and moving it up to your entry. So if price were to revisit your entry, you would get stopped out effectively at break even. Obviously there's some fees and things like that, but that's the idea. It's taking all of the risk off of the trade. Now, this might seem like a really good idea. Obviously, if you move your stop loss to break even, there's some comfort there knowing that you can't lose money on this trade. Again, we're going to ignore fees. The stop loss is at break even. Worst case scenario, you're getting out for a scratch, which is just fees. So you've eliminated any risk of losing, and there's kind of a psychological benefit of, comfort. Your risk is at break even. You're not going to lose any money on this trade. Those are the potential pros. Now, to talk about the cons, it's very important to remember that your entry is actually where you believe price is going to get a reaction. So if you're entering a long, your entry is where you think price is going to find support. If you're entering a short, your entry is where you think price is going to find resistance. If you were to move your stops to break even on a long trade, you risk having price come back down to support, which is where you had your entry, and you're closing your trade right into that support. Vice versa on the short short side. There's really only a few instances, in my opinion, where you should be using a stop to break even. If you have a really S tier entry where you're trading a breakout or something like that, and you're catching the breakout right as it happens, or a breakdown right as it happens, and price should not revisit your entry, then sure, maybe stop to break even makes sense. However, you do run the risk of potentially closing your long on a retest of support because you've brought your stop to your entry, which is at support, or closing your short at resistance because you've brought your stop to your entry, which was at resistance. So there are some pros. Obviously, you're taking risk off the trade, like I said, the psychological aspects of it, but the cons that I've listed also potentially mean that you're going to get stopped out of what could have been a potentially profitable trade. So we're going to go over a few different examples here. We're back in the breakout terminal. So let's use the same example from the last section. We have our breaker here on Ethereum. Price moved up. You're entering on the breaker. Your stop is down there. Your target is up there. In this instance, once price is trading away, you could bring your stop up to break even, moving it to right where your entry is. And you can see now you effectively have no risk on the trade. This is an instance where it would work out. Price never comes back to your entry. You have no risk on this trade. You can sleep comfortable at night knowing that even if price were to come all the way back down here, you would lose no money, of course, net of fees. So that's great. It worked in this instance. Now, what you have to be aware of is even though it worked in this instance, let's assume things played out a little differently. So here, price is trading up and you move your stop up to break even. And then price decides to come all the way back down here. You're now stopped out of this trade. You didn't lose any money. That's great. But what's happening here? Price is retesting your entry, sure, but your entry is at a breaker. And what's also formed after this move up is an order block. So you're getting stopped out at an area where price might bounce. So let's say you move your stop to break even, you go to bed and you wake up and you see this. You're probably going to be quite upset that you got stopped out of a long at support by moving your stop to break even. So that's going to be one of those instances where it's not really going to work to your favor. Another thing to add is the reason you have your stop loss where it was in the first place is because this trade idea and this retest here and this move up, it was wrong below here. That is where your trade idea is invalidated. Your trade idea isn't really invalidated at your break even point because in reality, you entered along there. That's support. That's where you want price to get a bullish reaction from. So I've seen this countless times where people will move their stop to break even too early. Price will come back and retest their entry, which is support. They get stopped out only to find that their trade idea would have worked out. And if they would have left their original stop, which is where the trade idea is wrong, remember from previous videos, they would have been totally fine. Obviously, the complete inverse here works on the short side. Now, I'll give you an example of where moving your stop to break even might make sense. In this same trade scenario here, right? Let's say you longed Ethereum and it's up a ton now at this point, right? There's no reason when prices moved this far away from your entry that you need to leave your stop loss all the way back down here. At this point, you can actually move your stop to break even. You could even continue to trail up your stop to higher prices. Maybe you bring it up to here. Maybe you bring it up to here. So in that instance, absolutely moving your stop to break even or even beyond makes sense when you're in a trade that's progressed very far. It's a swing trade or it's just a trade that has proven that it is going in the direction that you want. You can move that invalidation. The biggest issue people have is doing it too early. Like the example I showed before, where price moves in their direction momentarily, they bring their stop to break even, it comes and retests, and then it moves away. That's when you're going to get very frustrated. One other example I'll give you here is when I do think it makes, having your stop at break even. And again, I know I explained one there, but this would be the only other one. And it's kind of on a breakout or breakdown. So let's just zoom in here to like the low time frame. So we had a bit of a sell-off today. Let's say your breakdown shorting, this low here getting taken out. And you're like, I think this is going to nuke for whatever reason. We ran a high over here. I'm going to short this with my stop here. So if you're shorting some sort of breakdown and maybe it's a low time frame trade or you really think you have a dialed entry, perhaps in this instance, once price trades away, you should move your stop to break even because there's no reason for price to revisit your entry. If you're right about this being a breakdown short, price should likely move down quite quickly and not come back and retest your entry, because if it does come back to your entry, there's a very good chance your trade idea is wrong. And that goes back to the previous video where we talk about stop losses in general. The stop loss is where the trade idea is wrong. So if you're gonna move your stop to break even, the only reason you should do that is because if that level is now a level where your trade idea is no longer valid. If you're moving your stop loss to break even and it's at resistance and you're in a short, you might be moving your stop to where price is going to reject from anyways. So if the trade idea is still valid with your stop loss where it is, there's not really necessarily a reason for you to then move it to break even. And more often than not, I see this a lot in beginners. They move their stop loss to break even too early and they end up getting stopped out of what would have been profitable positions. All right, guys, so last up, we're going to talk about exits. So there are 3 different types of exits that we're going to go over here. First is hitting your full take profit or your full stop loss. This means the stop loss that you enter when you set the trade and the take profit that you enter when you set the trade are cemented in there, and you are not exiting that position till one of those 2 orders is triggered. So you enter the trade and you're either going to be right or you're going to be wrong. Now, this is the method that I think is the best for beginners. It requires little to no management. Basically, you enter the trade and you're not doing anything until your full take profit or your full stop loss is hit. Next up, there's partial TPs or a partial stop out. So what this allows you to do on the upside is secure some of your gains when a trade is gone in your direction, while also leaving some exposure on for potential further upside. So let's say your initial target is 4R on a trade. You could close part of the position at 2R, locking in some gains and leaving a remainder on for higher prices. This also works to the downside, where if a trade is going against you, you could potentially de-risk some of that position by closing a partial, and then if you do end up getting stopped out, you haven't taken that full loss, or if price then does go up in your direction, you are still exposed, but you have less risk on the table. Lastly, there's trailing up your stop loss and potentially even readjusting and furthering your take profit. So this makes a lot of sense oftentimes for swing trading. As a trade is progressing, market structure is continuing to form in the direction of your trade, your invalidation can actually change. So let's say you're in a swing long, price makes a higher high, you can now probably bring up your stop to that former higher low, having a new invalidation. This can allow you to sometimes get more out of a trade by allowing it to continue to run, and instead of just having a take profit level, you're actually trailing your stop up and can continue to follow the trend until you eventually get trailed out of the position. Now, this is going to be a lot more common, in my opinion, for advanced traders. Over managing, so adjusting stops, changing your take profits once a trade is in motion is not something you should be doing as a beginner. As a beginner, you're best off having your entry, your stop, and your take profit in, and then doing nothing. Early on in your career, you're probably going to end up exiting good positions too early or too late by over managing them, as opposed to getting the desired result of squeezing some more profit out, reducing risk, and things of that nature. All right, so we're in the breakout terminal and we're now going to go over these different types of exits. Let's look at Ethereum here, the chart we've been using for most of this episode. Let's assume that you're taking a long based on this order block here. You've got your move up, you've got your retest of the order block, you decide to enter the trade with your stop below here, and you're going to target some of these old highs. With that in mind, we put our RR tool on there, and you can see this has a reward to risk of 7-to-1. So if you're taking your full take profit, full stop loss scenario, the first example we gave, this trade would pay you $7 when price trades to $4,000, which happens over here. If this would have went up and then came down, you would have lost $1. You would have taken the full 1R loss, the full stop out. So you're not doing anything in between. You're entering this trade, you have your take profit, you have your stop, and you're just letting it play out. Now, again, to reiterate, I think this is the best way to trade as a beginner. There's no over management, no risk of messing this up. You let the trade play out. It's also a whole lot less stressful. That being said, we'll talk about scenario number 2, which is partial TPs. So in this trade here, this is a swing trade, right? This is based on the hourly chart, but it lasts several days. And 7R is quite a lofty target. We're entering at 3,600. We're targeting 7,000. It's a 12% move. So you could take partial TPs throughout this trade. So perhaps at 2R, you decide to take some of the trade-off. So here you've realized $2 of profit, okay? You've taken a portion of the trade off. You still have $1 risk. Now the trade continues in your direction and it goes to full TP. Now you're not going to have $7 of TP appear anymore because you've taken a partial. So you've locked in some gains, making sure that you have a winner. But if the price does go fully to your target, you don't have as much of the position on because you've taken some of it off to lock in those gains. Now, where might that be a good idea? Well, let's say you TP some here at 2R and then price comes down and stops you out. Well, now you've locked in some gains and you've at least made some money. Whereas if you would have had the full TP strategy, you would have gotten stopped out and not made anything. So that can be an advantage. You're locking in some gains. You still have some room for price continuing higher. The disadvantage is if your initial idea was correct and it does run for 7R, you don't have as much risk on by the time it gets all the way to your TP. Now, this works on the downside as well. Let's assume that price is trading in your direction. It comes down. You say, you know what? I want to take some of the risk off. You close half here, and then it ends up stopping you out. You've now mitigated. You're not taking that full $1 loss. And again, if price comes down here, you close half, and then it ends up going up. Great. You reduce some risk, but you still remained in the trade. You didn't fully close it out. Your idea never got invalidated. Then price goes to your full target, but similar to the taking partial profit here at 2R, you don't have as much risk on the table. You're not going to make as much money on the way up. Again, I'll keep harping on this, but a lot of the stuff I'm discussing with regard to moving your stop and playing with the trade, taking partials and things like that, I think you should not do initially, because the amount of times you're going to see price do this and you're going to close being like, oh, it looks shitty. And then it goes up, you're going to be livid. The amount of times it goes to here, you don't close because you're like, oh, well, it's going to keep going. You get greedy and then it does this and then you're going to be super mad. So it's going to likely cost you money and cause you frustration early on. Trade management at this level, I think, should be saved until you have a pretty good strategy. You're comfortable in the markets, you're consistent, then you can start tweaking your edge in this way by using these types of things. And now lastly, we're going to talk about adjusting your invalidation. So this is a really good example of a swing trade where very clearly, in my opinion, once we broke above these highs, that's a pretty good sign that yes, you nailed the bottom and the price is likely going to continue to trade higher. So there's an argument to be made that your invalidation no longer is all the way down here. Perhaps you could bring it up to break even, because there's no way that if price trades all the way up here, that it should come back down here if your idea is correct. So you can maybe bring your stop up to here. You could maybe even bring it up to here. And then as price continues to make bullish market structure, makes another higher high here above these highs, maybe now you've brought your stop up to here. So what this allows you to do is you're de-risking. So if price continues to trade higher, you don't even have to take profit. Instead, you can just keep raising your stop loss to the higher swing points, and then eventually you get trailed out. And that allowed you to capture more of the upside move. And you basically were just moving up your invalidation along with market structure until price eventually takes you out. So this type of strategy can work really well in crypto, because right now, like we're seeing in a bull run, the market can continue to extend upwards for a very long period of time. And for some of these tokens where we see things go into price discovery, so there's no targets over to the left, you can continue to stay in a position if you have a really good entry, trailing your stop up as market structure continues to remain bullish. You can do this on low time frame trades as well. This works on all different time frames, all different trading styles. But in crypto specifically, if you were to swing long Ethereum at any point during this bottom period here, once price broke above this high, to me, your invalidation is no longer all the way down here. If you're right and price is going to continue to trade higher, you could probably pretty comfortably now bring your stop up to here and just see how high this thing goes and continue to do so. If we make another significant high above here, I would venture to say this now becomes your validation, and you can just keep doing this onward and onward and onward, and then eventually you get stopped out and you're wrong. You can also combine this with taking partials. Okay, price has rallied 50% since my entry. I'm going to adjust my stop and I'm going to take some money off the table. So those are the three main types of exits that you're going to deal with in trading. Now, obviously there's more complex stuff as you get more advanced into trading. You can get into things like hedging. You can get into things like pair trading. There's all sorts of crazy stuff that you can get into and other ways that you can enter and exit. But these are the three primary ones. And to reiterate one more time, I still think the full TP, full stop loss is the best route for a beginner. It's going to keep you from making unnecessary mistakes early on by over managing your positions. That's it for this section on trade management and execution. So we covered a lot in here, but I do think this is a very important video. When you start out, a lot of what you're going to be focused on is drawing up on the charts, your TA, stuff we covered in previous videos, the very basic stuff around risk management, things like that. This is how you take your trading to another level. Proper trade execution, proper management is going to increase your success rate. It's going to increase the profitability of your trades, and it's overall just going to make you a much more well-rounded and successful trader. I hope you enjoyed. I'll see you guys in the next one.